Hello, today we're going to be talking about accounting for joint ventures. Before we figure out the nuts and bolts of all of that, we need to figure out what a joint venture is, what joint control is, and what's actually happening. So, according to AASB 131, a joint venture is a contractual arrangement whereby two or more parties undertake an economic activity that is subject to joint control. And this joint control is a contractually agreed sharing of control over an economic activity. Now, there are quite a number of different types of joint ventures, and they all, a lot of them will all operate in slightly different ways, but according to the standards, there are three types of joint ventures. There are jointly controlled entities, jointly controlled operations, and jointly controlled assets. Each of those three are allowed to use the line-by-line method, and jointly controlled entities also have the option of the equity method of accounting. Given that we've already discussed the equity method with associates, we're going to focus on the line-by-line method. So what's actually happening in a joint venture? Well, we've got a number of parties, in this case we've got two, that put in resources into a joint venture. The joint venture will then undertake whatever the economic activity it is that it does, and then produce some sort of output. Now, the joint venture generally won't sell the output itself, but rather it will disperse the output back to the venturers. So they will get whatever the joint venture decides to disperse, and then from there the venturers are able to sell that inventory or that production output off to a third party, and that's where they make their money. So we have a number of things that we need to be concerned with in terms of the actual accounting. Firstly, we have the money being put in by the venturers. How do we deal with that? Secondly, we have the actual joint venture itself. It's sitting there, it has assets, it's probably bought additional assets, it's incurred liabilities. What role does all of that play in relation to the joint venture? 3, we have the output that is being provided back to the venturer. How does this get recorded? What costs get assigned to it? How do we work out those amounts? And 4, probably the easiest of all the parts, how do we work out what to do with the sale of the inventory?